Welcome to Capital Insights. As you probably know, a number of the equity market averages have gone on to new highs recently, the Dow, the S&P. That's good news. But what's been lesser reported in the financial news is that a number of price indices, consumer price indices, have also moved to new all-time highs. Price indices for meat, poultry, eggs, fish, rent, medical care costs. I could pretty much go on and on. In fact, the reason we're bringing this up today, and we think it's relatively important, is that we've seen some spikes really over the last couple of months here, and anomalistic price spikes that we haven't seen in quite some time. In fact, at the June FOMC meeting, the Federal Reserve meeting, Janet Yellen was asked about these little price spikes, and her answer was that at least for now, it's just noise. But it's very important because over time, what can really impact the financial markets is inflation expectations. And over the last 2 to 3 years, in this period of low interest rates, this period of high market values, one of the underlying, if you will, fundamentals has been that low inflation is allowing us to have these low rates, these high valuations, etc. So it's very important to keep an eye on this. It's those price spikes that we want to look at today because, again, we haven't seen these in quite some time, and I'll be the first one to say that a data point, 2 data points, they don't make a trend. We need to continue to monitor this. Let's have a look. What we're seeing right now is the year-over-year rate of change in the CPI for food. And you can see exactly what I'm talking about here, these recent little price spikes. But that's not a singular occurrence. It's not just in food. We're also seeing it in some manufacturing costs. Now, admittedly, one thing we need to remember is that oil and the price of oil is very, very important to the economy. Hydrocarbons are in so many manufactured goods that I would exhaust myself listing them to you. And you know that recently we've had a little bit of, if you will, geopolitical issues in Iraq, we've had little problems in Ukraine here, and potential gas supplies into Europe over time. But we need to remember that the price of oil today isn't much below some of the price highs we've seen over the last 2 to 3 years. This isn't some huge anomalistic spike in oil by any means. So let's take another look at another data point that's important. The Philly Fed, the Federal Reserve of Philadelphia, publishes a report every month that looks at manufacturing activity. And the reason the Philly Fed is important is that's the bulk, it's a big part of U.S. manufacturing activity. You can see in their prices paid indice right here, again, that little anomalistic spike, that near-term spike. So not only are we seeing this in consumer products, consumer prices, but we're also seeing this in input costs to the manufacturing sector too. Just noise? We need to watch in the months ahead. As we kind of step back, one other issue that's clearly getting into prices here and has been for quite some time is, and this may sound a little bit wild, but it's all of the liquidity that the central banks have created over the last X years. It's not just the Fed. It's the Bank of Japan, it's the Bank of China, it's the European Central Bank. A lot of liquidity that's not getting into the real economy, but it's getting into asset values. It's getting into real estate, it's getting into stock prices, and clearly it's getting into commodity prices too. As we look at, if you will, investment flows over time, one of the big areas where we've seen investment flow is into farmland. Whether you know this or not, the price of farmland has tripled over the last 5 years, and a lot of that is institutional investment. This isn't just hedge fund money by any means, but it's pension money. What happens when the price of farmland triples? Agricultural prices go higher. Oil likewise. As oil prices go higher, one of the key components in ag costs is energy prices. So it's so blended in terms of effect here that we really need to look broadly at what's driving prices. But again, these little spikes over the recent past are something to take notice of. Finally, and this is a little bit of an encouraging sign, over the last month, small business optimism has gone up a little bit. That's been something that's been lacking in the current economic recovery. Small businesses just haven't fared as well as their large business brethren have. But what we saw in the last month was a big spike in the anticipation of prices that small businesses expect to receive over the near term. They have a little chart that we're looking at right now that shows their expectations for prices 3 months from now. Now look, small businesses have had a very tough time. They aren't out there raising prices because magically the economy is getting better. They're raising prices, and they need to raise price because their input costs are going higher. And it's not just input costs, but the cost of doing business itself. As I'm sure you're fully aware, for the corporate sector and the small business sector, the cost of Affordable Health Care Act, the Obamacare Act, if you will, it's been called, comes into play next year. And a lot of small businesses need to anticipate that right now. And I think that's exactly what we're seeing. So we're, again, seeing them anticipating raising their prices over time. This is all short term. This isn't about some runaway inflationary expectations. In fact, as we really look long term, and I'll be the first one to tell you, there is no way that we're facing a runaway inflationary experience. Why would that be? Well, it's really because we haven't seen wages go up. And as we've gone back and looked at this historically, the only way consumer prices go up and maintain huge jumps in prices over time are if wages follow them. One last chart. We're looking at the year-over-year rate of change in average hourly wages in the United States right now, and you can see we're at nearer half-century lows than we are at highs. So we're not talking about the beginning of runaway inflation. What we're talking about is the potential for change at the margin. It's one of the most important constructs in the financial markets. Again, finally, back to the financial markets. What does this mean? What has really underpinned the bond market over the last 2 to 3 to 4 years is the thought that inflationary pressures are subdued. There is no inflation. Is that right? Is that wrong? We have a number of data points that are singing in multi-point harmony right now, just telling us to be aware, to monitor, and watch as we move forward. Across consumer prices, small business prices, manufacturing prices, this is multi-part harmony that we haven't seen in a long time. What it also reminds us is that in the equity portions of our portfolio, we very much need inflation protection over time. So again, following these data points, very, very important. Again, Ms. Yellen told us in the recent meeting that these data points, these inflationary pressures, these little spikes are just noise for right now. Is that the case? Or are these data points, Yellen, a different message? We'll find out in the months directly ahead. We very much appreciate your time. On behalf of the entire team at Capital Planning Advisors, thanks so much for being with us. I'm Brian Pretti.